Welcome back to the Trading Desk. I wanted to share an email that I received this week from a potential client and viewer of the show. And essentially, guys, I shared the email with you, but essentially the email was, I'm interested in investing in currencies. I'm interested in investing in alternative asset classes like commodities. You know, I've got X amount in my retirement. But the theme of the email was, I can't talk about these alternatives with, you know, your traditional stockbroker, traditional money manager. They don't. It's like the third rail of politics. They don't want to touch it. So,
and I think he was expressing some exasperation with the fact that stocks have gone nowhere for 10 years. You know, and people are getting to that age where they're thinking about retirement, and well, if stocks go nowhere for the next 10 years, how am I going to retire? Type thing. And so
I agree, but I also think, and we were talking about this earlier, I think he was also thinking about gold at $1,000, commodities at oil over $110.
Right.
I think he was thinking, I better get on this commodity train before.
Yeah, and so he's starting to, again, go back to your sentiment indicator. When you start to get those calls from the people who don't normally talk about those alternative assets, maybe that's not the time to go all into that class.
But it's a valid question because it allows us to point out the fact that you do need to have a timing mechanism in your portfolio. Maybe now is not the time to invest in commodities. In fact, I think it would be horrible to invest in commodities right now.
Right.
Currencies doesn't mean if you're short or bearish or bullish the dollar, you should have a currency exposure at least.
Again, what is your time frame? How what type of expectations do you have in investing into gold or currencies? Are you looking for a 10% annual return? Well, now may not be the right time on the long side, but it may be on the short side. Maybe you have that discussion. You can play both sides of the market, and that's okay. And I think one of the simplest indicators I like to tell people, and again, I'm a chartist, you're a chartist, Jesse, you look at charts, we all use charts. And even if you're an investor and you know something about the semiconductor business or the food business, you still need to take a look at the chart. The chart basically tells you where the buyers and the sellers en masse have been, and getting back to sentiment, getting back to where's the boat the most likely to capsize. Because the market, again, you can think about it, the market is always out to hurt the most people.
Right.
Because when the masses are together, they're usually wrong.
Right.
And those that are thinking differently are the ones that may take advantage of those situations.
But I'm sorry, go ahead, Jesse.
I was going to say, to put it bluntly, I use the email as a contrarian indicator, as a sentiment indicator.
Absolutely.
He said, I want to own commodities and foreign currencies. And I just use that to reinforce. I've said it on the show that I think foreign currencies, I think the dollar's ready to bottom, and I think commodities are topping out. Mm-hmm. So I don't think it's the time to own either of those asset classes in my mind. They've already gone up so much.
You need to clarify, though. By owning foreign currencies doesn't mean that you're bearish the dollar. I mean,
right. If you're owning the euro versus the British pound or something like that. I'm talking about the foreign currencies versus in dollar terms, because we live here, and if we buy a foreign currency.
Right. And I agree with you. But let's go back to what the guy's email was. Let's assume he was sitting across the table from us right now. What are some general things that that person should be considering and doing?
Well, again, I think one of the simplest things that anybody can do with the internet, you can go on and get you can go to Yahoo and get it.
Not having the investor do necessarily all. What would we do?
Well, what I would do, first thing, I always take the bird's eye, the top of the skyscraper view, and I'll take a weekly or a monthly chart of whatever asset class I'm looking at and see what the history is over 20 years, 50 years, as long as I can go back. And then I want to look at, I'll use a simple overlay of 10 and 40 week moving averages on the longer term view. Mm-hmm. And whenever the quicker the 10 period is above the 40, I want to be on the long side. When it's below it, I want to be short. Mm-hmm. That keeps me on the right side of the market. So I know if it flips over and goes to the sell side, I don't want to be long anymore. I can get short, or I can be out of the market for the drop.
Something as simple as that would have kept you out of this mess we've had for the last 5 months.
That is a great way to take the temperature of an asset class.
Bingo.
You can see, is this in a bull trend or is this in a bear trend? Over long periods of time,
it's enough time.
You definitely want to invest with the trend.
It's not going to call the top. It's not going to call the bottom, but it'll get you into the trend.
But those moving averages turned up in 2003, late 2003, when the stock market was getting bullish again.
Didn't get you in March, but it got you in probably July, August.
They crossed down in late 2000, and they got you out of stocks at the right time. That indicator got you back in.
And they crossed Delta again
Good time
here in
also.
November. So you would have been out in November for this last bit of, last
bloodbath,
150
You would have
points.
missed the massive sell-off.
we gotta take a break here to pay some bills. When we come back, we're going to continue this discussion, and after that, we'll get to our fantasy finance in the last segment of our show. You're watching The Trading Desk on COTV.